retirement, a time to relax, enjoy life, and reap the rewards of your hard work. But have you considered how big of a bite Uncle Sam might take out of that hard work? And have you considered how a Roth conversion may help you optimize your long-term retirement income strategy? I'm Nate Miller with Miller Retirement Group, and let's dive into the world of Roth conversions and discover their significance. So if you're not familiar with the concept, let me explain. A Roth conversion is a process where you move funds from a traditional retirement account, like a 401k or a traditional IRA, into a Roth IRA. The key difference is that contributions to a traditional IRA or 401k are tax deductible, while Roth contributions are not. They're made with after-tax dollars. And the primary advantage of Roth conversions lies in the treatment of the withdrawals, the tax treatment of the withdrawals. By converting funds to a Roth IRA, you pay taxes on the converted amount up front. However, once the funds are in the Roth IRA, they grow tax-free, and qualified withdrawals in retirement are also tax-free. And now you might be thinking to yourself, Nate, you're saying that by paying taxes now, I can potentially avoid paying taxes on my retirement income later. And exactly. It's like paying tax on your seed rather than your harvest. I grew up on a farm, so I'm going to use a farm analogy. Roth conversions allow you to strategically manage your tax liability in retirement. By converting a portion of your traditional IRA money each year, you could create a tax diversified portfolio. And the flexibility can be incredibly valuable, especially during times of changing tax laws or when you need to manage your income to qualify for certain benefits. And additionally, Roth conversions can be particularly advantageous for those that expect their tax rate to be higher in retirement. And yes, that does happen, actually a lot more than you might think. By paying taxes at your current rate, you could potentially avoid higher taxes in the future when you withdraw funds from that Roth IRA. And so you might be thinking, all right, that makes a lot of sense, but Nate, how do I know if Roth conversions are right for me? And that would be an excellent question. So determining your optimal strategy for Roth conversions depends on a few various factors, such as your current tax bracket, retirement goals, your financial situation, and it's crucial to work with a knowledgeable financial advisor and tax professional who can assess your unique situation, your unique circumstances, and guide you through that process. And so let's look at a hypothetical example here. Bear with me while I share my screen here real quick with you. There we go. Do that. Okay, so what we've got here is, let me set up the scenario. There's the gentleman, he's in his mid-60s, and they're in a 25% tax liability, and they're going to stay in that 25% tax liability when they retire, because that's what we've noticed. The vast majority of people actually do stay in the same tax bracket when they retire. They're not actually in a lower tax bracket like what we were told. And since it's not what we were told is actually happening, now it's time to come up with some type of an exit plan without paying too much unnecessary tax. So back to the example here. And this guy, he mid-60s, he's got $500,000 in his IRA, and it's going to grow at about 5% annually. Now, in his case, he doesn't need these withdrawals. When he gets to his required minimum distribution age, he's just going to start taking those required distributions, pay the tax on them, those reinvest the ones that he doesn't need, and then he's going to just live off of his Social Security and pension like before. And he's going to live to be about 90. And all the assets are going to grow at about a 5% average. And so during that time frame, during that life, the amount of tax that he will pay on that $500,000 balance, that $500,000, is $158,235. And that's just on the required distributions. The ones that he has to reposition out because he doesn't need them is going to be about almost another $70,000. You're looking at $69,976 right there. And so that's significant. And then unfortunately, when we pass away, Uncle Sam is not done with this. And so our kids may have another six-figure tax bill on what the remaining balance that they inherit, about another $110,000 there. So that's how our taxes work throughout our lifetime. The total amount of tax is $338,000 and change. That's a big number. That's way more than the 25% tax liability that we saw that we're using here. And so that would be what we call the do nothing strategy. That would be, we're not going to convert to a Roth IRA at all. We're just going to leave our money in the traditional IRA, take our income that we're required to take, reinvest what we don't need, and just pay taxes. However, there are what I call mandatory and optional taxes, and these would definitely be optional in my opinion. So another strategy would be what we call the Roth IRA rollout, or I call it the Roth IRA rollout, and switch the IRS letters on its head. Instead of IRS, it's SRI. It stands for Strategic Roth Integration. We would not do that all in one year. We do it over several years. And so let's say we got the full $500,000 converted over several years. And again, we're in the 25% tax liability. That is only $125,000. And as we have said earlier in this video, there's no taxes paid on the growth inside of an IRA. And when we pass away, our kids don't have to pay anything either. So the total tax liability there is only $125,000. And so now what we've got is a $338,000 versus a $125,000 decision, a $213,000 decision. So this person basically saved $213,000 over their retirement. And so this is I always ask the question, if I put $213,000 back in your account, would that be a good thing? And would your portfolio last longer? And the answer is absolutely yes. And that's why tax planning is part of our process, our financial planning process. So you have to remember that planning for retirement goes beyond just simply saving money. Roth conversions could be a powerful tool to optimize your retirement income and potentially minimize your tax burden. And so you should consult with a trusted financial advisor and tax professional to explore how Roth conversions could fit into your retirement strategy. And retirement should be a time of financial clarity and confidence. With the right knowledge and guidance, you can make the most of your retirement years. And if you want to start exploring how tax-efficient strategies could potentially improve your retirement today and embark you on a path towards a brighter retirement future, then you can download our complimentary white paper titled, "Are You Paying Too Much Tax in Retirement?" And it'll be a great resource to start understanding the impact of good tax-efficient strategies in retirement. And so thanks for joining. Stay tuned for the next installment in this tax series, where we teach you how to really get the most from your retirement. Because what we're trying to do is empower you to live the retirement you deserve. Thank you and take care.